So this is the practice assessment 2 for the advanced synoptic for AAT level 3. Now this practice assessment 2, it is from the BPP question bank, and that assessment number 2. And as usual, we know we're going to expect, we are going to see 6 questions in the exam, we're expecting 6 tasks, and obviously every task will have a breakdown. The first task always comes from the ethics part, and obviously it's not like before. There will be no spreadsheet in this synoptic exam anymore, so it will be only the 6 tasks, that's it, and Excel or spreadsheet will be have a separate exam. So let's start with this one. We know the story, how the exam will come. We have a few sessions before, so let's start the question straight away. So the first one's the same thing. They always say task 1 is based on the workplace scenario, separate to the rest of the assessment. This one is like a standard. So this task will be separate, and there is no link with task 1 to the another question in this paper. Task 2 to task 6 is based on the scenario of a sorter, which is as follows. You are Jamie, a part qualified accounting technician employed by Broadcrutch and Co., an accountancy firm. So you are a trainee accountant who work for accountancy practice. The client you are working on in Souter, and your firm provides bookkeeping and the accounting services for the business. Souter manufactures nightwear and is owned and managed by there is another employee, Misa. So she is the one, she manages all of this for the manufacturing process. All right, let's try to understand this ethical question from here. The first one is asking complete the following sentence, task 1 for 15 marks. A professional accountant who comply with the law brings no dispute on professional and is perceived as being ethical by other people has complied with the fundamental principle of what. So we have few fundamental principle, and the person who follow this all of this what of the fundamental principle is comply with. So you can see on the checklist we have a few checklist, and we have few information. We have a confidentiality, integrity, objectivity, professional behavior, and professional competence and due care. So this one is no link with the confidentiality, nothing relevant to the integrity, nothing relevant to the objectivity, because objectivity is always represent are we are biased to the client or not, and the professional behavior is the one that is relevant here, because as a professional accountant we have to comply with the law and bring no dispute on the profession. So we should not do anything that not only damage our profession, it will damage our institution as well. So should not do anything that will that could raise a question like about the profession. So that's why it is more relevant to the professional behavior. Professional behavior. So it is our professional duty to follow the law, and that brings no dispute with the profession, and we act ethically. Let's move to the next one. The next one it says the requirement for ethical business practice means that sustainable development and corporate social responsibility are becoming increasingly important. Now, the CSR or corporate social responsibility, it is beyond the responsibility of maximizing the profit. So, for example, for a profit-making organization, their main aim is to make the profit. So, if any profit-making organization or any company, their main purpose to maximize the profit for the company. But nowadays, the corporate social responsibility, that is not their main aim, but also it is very important so that they can tell the society, they can tell the country, or they can tell the people or the customer like they care about the social impact. For example, they care about the environment, they care about the local people, they care about the job. So that's why nowadays most of the company, they try to show their corporate social responsibility. For example, Tesco, they do a few activities to say like they they donate the money or they do the charity to save the children, or like they have a fund for the cancer research UK. So there is a lot of company that try to show they are doing beyond of their responsibilities or beyond of their main goal. So they are not only focusing to make the money, also they are doing something for the society. So this is kind of comes under the corporate social responsibility. And here they said, which one of the following is true in respect of the accountant role in sustainable development and corporate social reporting? So which one is the more relevant for an accountant? Let's have a look. Sustainability and CSR are not financial matter, sit outside the remit of the professional accountant. That's not true. They're saying like as an accountant, we really don't have to follow the corporate social responsibility because this doesn't come under the financial matter. The next one we have here, sustainability and corporate social responsibility form part of the accountant obligation to work in the public interest. That's true. So this is the one is more relevant because sustainability and CSR form part of the accountant obligations. As an accountant, we have obligation to follow it and to work for the best interest for the public. Let's move to the next one. The next one we have again from the ethics, and let's have a look at this one. Danny is a professional accountant working in a practice. While carrying out some work for his client, Inge, he has acted outside the limit of his professional expertise. As a result of work carried out by Danny, Inge has now incurred a regulatory fine. So this has happened when you have a client and if you don't look after the client properly. For example, one client have a tax return due 31st of January, for example, and you forget, you are the accountant for that client, and you forget to submit the tax return on behalf of him or on behalf of that client. So what will happen? Because of that, the client can receive a penalty. Now, if you are acting as an agent on behalf of the client, then it is your responsibility to make sure the client do not receive any sort of penalty because he gave you the job to you and you should submit the client information on time to HMRC or company house. So if you don't do it, it will come under the professional negligence and the client can claim you back. So the client can come back to you and claim on you to tell that like you did not do your work properly, and for that reason he end up with the fine. So you can get a fine from your professional body, from the court, from other place. So if this has happened, it is possible you can lose the license for the practice because you didn't take care of your client properly. So this will be under the professional negligence. So if you do not look after your client properly, and if the client come back to you and they said he can do the penalty, he can get the penalty, or he can take sort of action against you because he didn't take care of him properly. So this comes under professional negligence. Let's move to the next one. The next one we have here, it says, S Limited, a small home electrical company who you have worked with for a number of years, has unexpectedly requested your practice to help in selling a number of residential property that they may have recently acquired. Okay. Instead, whether the customer due diligence should be carried out before accepting the work. Now they're asking, you should accept this work before any check. So due diligence comes under the checking of the client. So before you accept any client, you should check about the client identity, the client background, and the engagement you are taking, you should make some research, or you should check before you accept him that. So all of this comes under the customer due diligence. Now it is possible you have some sort of old client, and this client can come back to you. And of course, like if this client can come back to you, and you really don't have to feel like, okay, I know this client from the before, so I really don't have to check anything. The answer is you should. Every time, even the old client come back to you, still you have to check again to make sure like you're happy with all the papers, with all the documents. So it's not, you know, this person by somehow, or someone recommend to you, for that reason you don't have to check the client. It's not going to work. So you always have to double check every time before you take any engagement. So here they're saying due diligence procedure are not necessary as this situation relate to an existing client. So this is your existing client, so you really don't have to do any check. The answer is not true, it's false. Even though you know this person is your previous client, still you need to carry out the due diligence procedure. The next one we have here, you should report this matter urgently to the relevant authorities. There is clearly something amiss. Now this is not true. We really don't have to inform the authority for that. So you will carry out the check, but it's not something very urgent like a money laundering or something that you have to inform to the relevant authorities. It's not true. So you really don't have to do that. It's not that urgent, something happening wrong here that you have to inform to the authorities. All right, so let's move to the next one. Next one we have here, a little bit scenario we can see. You are a newly qualified accounting technician working in a practice. Your colleague Pierce has been off work sick for the past week, and your line manager asks you to go through his entry and deal with anything that needs to urgent attention. In Pierce's entry, you found a letter addressed to Pierce from one of his clients, Martin. In this letter, Martin asked Pierre to include a revenue figure in his tax return, which is much lower than the actual revenue received by the client. Martin offers Pierce the thousands you need to clear your gambling debt. In return for inclusion of this incorrect figure, Martin also suggests that if this is not done by the end of the month, he will inform the firm of the owner other way in which Pierre has helped him to present suitable figure in the past. So basically what's happening here, he's asking some help, and that is unethical and maybe a criminal offense. But he's saying like, if you do that, he will give Pierce £1,000, and if he don't listen to him, if he don't do it, then obviously he will tell the firm other way that you helped him before. So that means you've done something wrong, and obviously he is threatening you to disclose that. Now he will expose it to the people. Now, when it has happened, there is two threats, we can see it here. The first one, 1,000, you will get if you follow his order. That is self-interest, because if you listen his order is a self-interest. On the other hand, if you don't do it, that means he can tell someone else or anything. He giving you pressure. So for any reason, if you feel a pressure, it is intimidation threat. So it is an intimidation threat. So you have two types of threat here. One is the self-interest and one is intimidation. Self-interest, because I will be benefited if I listen to him. And the intimidation is I'm feeling threat if I don't do it. So we said, okay. So we'll do that. The first one, complete the following sentence. As a result of this letter, Pierre faced threat of self-interest. So self-interest, number one, and intimidation. intimidation to the professional ethics. So you have threat of self-interest and intimidation. You listen to him, it's a self-interest. If you don't listen, then he giving you some pressure. This is the intimidation threat. The next one we have is state which three of the following of peer fundamental principle are threatened by this letter. So the first one is integrity, of course. He done something wrong in the previously, so it is a fundamental threat created from this letter. Objectivity, obviously it is not true, so it's a self-interest threat. He getting some own benefit is also self-interest threat. And also finally, professional behavior. If we do that, it's not professional. There is nothing confidentiality here, and there is nothing with his working experience. So the competence and the due care comes with how experienced he is to carry on the work. And confidentiality is all about how much confidentiality he can keep in order to do the work. So this is not relevant here anyway. The last one we have here, which of the following action would be most appropriate for you to take on discovery of this letter? So you found all of this story. So what will be your best action? So you remember that if you find anything, your always best action or the immediate action will be discuss with your immediate manager or immediate supervisor or someone who is senior than you or you are under with him. So you need to always talk to your senior manager or the line manager who is in charge of you, and before you tell anything to the outside people or any other authority. So you don't tell to the other authority, you just inform to your immediate manager first. And if the immediate manager don't take any action, then you think about the other steps. So I say discuss the situation with your immediate line manager. So you have to tell him first. If he don't listen to you, then you might disclose this information to the MLRO or for any nominated officer. All right, let's move to the next one. The next one we have here is look like we have to do a journal. So let's read this question. Task 2 for 12 marks. It says you are Jamie, a part qualified accounting technician employed by Broadcrouch and Co., an accountancy firm. The partner of the B&Co, Mr. Tennant, has asked you to answer some questions which have come into the office from Jonas, the accountant assistant at your client, Sauter Limited. Okay. Sauter has purchased a new delivery van from Van & Co. using a bank loan to fund the purchase. Jonas is unsure how to account for it and explained that he has heard of depreciation but does not understand what it is and how to calculate cost of the van, and we have a scrap value. So cost of the van is this. Expected scrap value. Scrap value, sometimes you call it residual value, is the same thing. And the useful life is 3 years. That's fine. It's not the difficult thing. Remember, the first thing we need to do that the question is asking how to account for the van. Now they said through the bank loan. Normally, when we take a loan, we do two journal. So first journal for the loan. So loan to bank. So loan to bank. When you take the loan and deposit to the bank. So normally the bank is debit because the loan comes to the bank. So bank is debit 13,500. And loan is a liability. Loan is a credit 13,500. Now after you use this loan to buy the non-current asset, so that time this non-current asset, here it is a van, so van at cost. So van will be debit because van is a non-current asset, 13,500, And bank will be credit because money will go from the bank. So when we take a loan from the bank, and if we buy any non-current asset by using this loan, we have to do two journal. So one for taking the loan, that is bank is debit, loan is credit. On the other hand, the van is debit and bank is credit. Now, ultimately, you can see these two will be gone. The bank debit will cross the bank credit. So that means this will be gone. This will be offset automatically with each other. So on the system, we'll have a van debit and loan credit. If you understand the steps, you can write it straight away, van debit, loan credit. If you don't understand it, you can write the way you want. You can make a breakdown for that and you understand it, because two journal, you have to end up with one. So we'll say van at cost will be debit 13,500 and the loan will be credit 13,500. That's it. The next one is asking about the depreciation. So let's have a look what they said about the depreciation. So what is the annual depreciation charge for the new van on a straight line basis? Now it's very simple to do the depreciation. We know how to do it. So he said cost minus scrap value or residual value, whatever it is, divided by useful life. Useful life. So we have a cost 13,500. We have a scrap value 1,500 divided by 3. And that will give us 13,500 minus 1,500. And it will give us 12 divided by 4 is 4,000 per year. 4,000 per year. So this is our depreciation. So depreciation is straight line 4,000 per year. So it's not the difficult one. We know how to do the depreciation. All right, let's move to the next one. The next one is number C. Number C is asking, which two of the following statement about depreciation are true? Now, depreciation is a non-cash item. It is spread of the useful life of the asset, and also it will reduce the value of the non-current asset. On the profit and loss account, we account for depreciation as an expense, and on the other hand, on the statement of financial position, we take away the depreciation from our non-current asset. So this is the story of the depreciation. The first one, they said depreciation is spreads the cost over an asset over its residual life. That's true. Residual life or useful life, whatever comes, is true. All tangible non-current asset must be depreciated. It's not always. Like, for example, land. We know the land we never depreciate because
Tomás lo sacó para después dejarlo.
so it's not like all tangible asset we have to do the depreciation. Some asset the value goes up, not goes down. So it's not true. Then depreciation is debited to the retained earnings. That's not true. Depreciation is debited to the profit and loss account and credit to the statement of financial position. Accumulated depreciation reduces the carrying amount of the tangible asset. That's true. Every year, we take away the depreciation amount from the non-current asset value. And slowly, the value of the net book value of the asset will be reduced. And one day, the asset will be vanished from the financial statement. All right, let's move to the next one. The next one we have here. Jonas is also unsure how to deal with the trade receivable at the year end. The draft sales ledger control account balance at 31st December 2018 is 62,000. There is also an allowance for the doubtful debt. However, this figure is from the 31st of December 2017. So that's the opening balance from the last year. Okay. The managing director, Misa, has informed Jonas that one, Souter client, Live Star is no longer trading. Souter has outstanding balance in the sales ledger relating to Live Star is 6,700. That means this customer gone bankrupt. That means this customer will not be able to pay your money back. So in this case, if this has happened, we have to write off that. So if any customer said, I'm bankrupt or I don't have any money to pay, so we have to reduce this customer balance through the irrecoverable debt, because this debt is not possible to recover anymore. Jonas is aware that Souter usually makes an allowance for the doubtful debt based on 2% of the outstanding sales ledger control balance. Okay. Now the next question here we have the requirement adjustment to deal with the irrecoverable debt. It's a very simple journal for the irrecoverable debt. Irrecoverable debt is expense, that's why it is a debit. And because of the irrecoverable debt, the total sales ledger control balance has to go down. So normally sales ledger control is a debit. If I like to reduce it, I will make it credit. So I will say irrecoverable debt expense debit. So irrecoverable debt expense debit. Normally it goes to the profit and loss account on the debit side. The amount is 6,700 because we're not going to get this money from this customer. And because of that, sales ledger control balance will go down with the same amount. And that's why it is a credit. All right, let's move to the next one. The next one we have here, which of the following is statement about the allowance for doubtful debt is correct? Now remember that we have a few things. One is like doubtful debt, and one is doubtful debt allowance adjustment. So one is allowance for the doubtful debt. One we have allowance for the doubtful debt adjustment. Careful with these two. Allowance for doubtful debt is the item of statement of financial position. So this one we take away from the sales ledger or from the trade receivables. On the other hand, allowance for the doubtful debt adjustment, this one is item for the profit and loss account. This one can be debit or can be credit. Depends, we have to increase the allowance or we have to decrease the allowance. So very careful with that. Let's read this requirement. Which of the following statement about the allowance for doubtful debt is correct? So let's read this one. Allowance for doubtful debts is an expense in the statement of the profit and loss account. That's not true at all. It is not expense and it's not belongs to profit and loss. The allowance for doubtful debt increase the trade receivables. That's absolutely wrong. It decreased the trade receivables, not increase. Allowance for doubtful debt reflect the possible non-payment of some receivables balance. That's true. This is the one. So it's a reflect the possible, it's a possible non-payment. So we have two things. One is doubtful debt. So doubtful debt means like I have a doubt, like some customer not going to pay me. This is doubtful debt. I have a doubt. I'm not 100% sure, but I have a doubt some customer not going to pay me. On the other hand, allowance for the doubtful debt means I keep some allowance because if the customer don't pay me, for that reason, I keep some allowance. It's like a savings I keep. So I know some customer never pay me, and for that reason, I keep a savings. That's the allowance. And if I know some customer will not pay me, that will reduce the total customer balance. And for that reason, it will reduce the trade receivables balance. Let's move to the next one. You have calculated allowance for the doubtful debt 31st December 2018 to be 1120. Complete the sentence below to show the correct amount of the allowance for the doubtful debt. Now this one we have to do some workings. So they said the closing balance we can see 1120. That is 31st of December. Now we have some opening balance in the question. So let's have a look. How much was the opening balance? So they're saying 2% of the outstanding sales ledger control account balance. So let's do this workings to calculate the 2% on the outstanding sales ledger control. So let's try to do that. So we have the sales ledger balance, that is 62,700. So we have a 62,700. This is our sales ledger control balance. And from there, 6,700 we're not gonna get. So we have to minus it. 6,700 we're not gonna get. We have a 56,000 left, times by 2%. So we have times by 2%, and that will give us 1120. So now if you go there, you can see here we have 1120. That's the closing balance. Now obviously, if it is the closing balance, we need to see how much it is increasing or decreasing. This is the question is asking. So let's have a look. The allowance for the doubtful debt allowance will be increased or decreased by. So let's have a look how much we can show on the statement of financial position. Just need to make sure, is there any other information we have linked with this question? So you don't see anything here. So it's said, okay, that's fine. We are happy with that. Now we need to see how much you already have. Now we can see we have 1,600. We already keep this figure from the last year. So on the balance sheet, on the trial balance, we already have 1,600. But after we calculate, we see our closing balance. Closing balance should be 1120. How we do that? 62,700 minus 6,700 that we're not gonna get, times by 2%. That will give you 1120. So we should keep 1120, but we already kept 1,600. So we kept more. So we need to reduce it. So I said I need to reduce it. Decrease by how much? 1,600 minus 1120. So that will give us 480. 480 I need to decrease because I kept more than my estimate. So this year my estimate, we should keep the allowance 1120, but from the last year I already have some opening balance that is 1,600. So we need to decrease it by 480. So we need to say that we need to decrease by 480. So we said doubtful debt allowance will be decreased by 480. That's it. All right, move to the next one. The next one we have here. What is the next course of action? Sauter has considering acquiring some new machinery through a lease agreement. You are unsure how to deal with this type of accounting. So if I don't understand, I always talk to my line manager. Remember that if I'm not sure about anything, I always have to talk to my line manager. So I'll say, I will consult with your line manager. So if I am not sure about anything, I always have to consult with my line manager. All right, let's move to the next one. The next one we have here is state the fundamental principle which is at risk in this scenario. So I don't know the word properly. So of course, let's go with the competence and due care. Say nothing about the confidentiality because I'm not telling something confidential. Nothing is threat here. So only I'm not capable of doing the work. So it's come with the competence and the due care. So this is the risk. If I do the work, maybe the work will not be qualityful because I don't have enough experience or the resources to carry on the work. All right, let's move to the next one. Next one is activity 3. Let's try that. This question is from your management accounting. Question from the management accounting sometimes could be tricky. Remember that. Financial statement question normally is not very difficult, but question from the management accounting could be really tricky. So let's try to do this one. This question, let's read this one quickly. So Tamisa has recently been to a meeting of a local businesses leaders and heard about the concept of marginal costing. She would like to know the effect of costing outer product under marginal costing principles instead of full absorption costing. Now, the only difference is between the marginal costing and the absorption costing. Absorption costing consider the fixed cost as a product cost. So inside of the product, we'll have a portion of fixed cost. For example, let's say if I use the absorption costing to make this pen. So inside of this pen, there will be a portion of fixed cost. For example, the rent or fixed overhead, anything. So portion of fixed cost will be here. Now, if I use the marginal costing, we only consider the variable cost. So fixed costs do not consider under the marginal costing. So we consider this one as a period cost. So marginal costing method says the fixed cost will happen anyway, so you don't have to keep the fixed cost inside of the product. So product cost or the inventory cost will be only consider the variable cost, but the absorption costing say no. Inside of the product, there should be a fixed cost, and that will be part of the inventory. This is the main difference, nothing else. When you use the absorption costing, we find the profit, but when we calculate the contribution under the marginal costing, first we find the sales price, we minus all the variable cost. First we calculate the contribution, then we minus the fixed cost to get the profit. So let's do this one. The first one, they said calculate the contribution per unit. Very simple, selling price minus all the variable cost. So let's do that. So I said marginal costing. First, we have to know the selling price. How much is the selling price? Is 19. From the 19, we will minus all the variable cost. So we have a direct material, that is variable cost. So direct material, £4. Then you have a direct labor, this is variable cost, £3. Then you have a variable production overhead, that is £2. And we have a variable production opening inventory, then fixed. So our story is done for the marginal costing. So we minus this one, minus that, minus that. So we minus all the variable cost from the selling price. So 19 minus 4 minus 3 minus 2, that should give us 9. And if I minus the 9 from the 19, it should give us 10. So the contribution is 10. If the question said you must show the workings, you need to show how you end up with this figure. So you need to write direct material, direct labor, and selling price. So you need to show how you end up with the contribution. Don't just write 10. You're not going to get the full marks. So you need to write all the workings as well. All right, it's not very difficult. Contribution is quite simple. The next one we have here, calculate the profit per unit using the full cost. Full cost means we understand is absorption costing. Even the question don't say absorption costing, full cost means is absorption costing. You must show all the workings. So let's try that. So we have already the variable cost, this is 9. All we have to do, we have to add the fixed cost. Now, if we don't have the fixed cost per unit from the question, we have to find it out. So how do we find it out? We find the total fixed cost. This is 9,600 per month. And then we have the unit. So how many unit per month? We have 2,400. So let's do that. So we can say 9,600 divided by 2,400. 9,600 divided by 2,400, and this gives me 4. So 9,600 divided by 2,400, this gives me 4 per unit. So fixed cost per unit is £4. All you have to do, you have to add £4 with this 9. So it will be variable plus the fixed. So total it will be 9 plus 4, it will be 13. So if I minus the 13 from 19, how much will be the profit? So 19 minus 13, it will give you the profit 6. So profit will be 6 per unit. So under the absorption costing, the profit will be 6 per unit. All right, you have to show the workings of the question. Said explain one advantage to using marginal costing and one advantage of using the absorption costing. They're asking two advantages. Now, obviously, that's a theory question. You need to just write two. There's only 2 marks. We don't have to write really more. So you need to write one advantage. So under the absorption costing is cover all cost. So it said under AB absorption costing, it cover all cost for a product and the managers can take the decision more wisely. This advantage. So if the manager can see how much is the total cost of a product, they can take the decision more wisely. And then number 2, we found one advantage for the marginal costing. So marginal costing always useful for the short-term decision making. For example, if you like to distribute some product, or if you like to launch a product in the market for a short term, marginal costing will be very, very useful, because in a short term you will withdraw the product and end up with the profit, and you don't consider the fixed cost, because fixed cost will happen anyway. So for the short term, decision making, marginal costing is helpful. So if you consider the fixed cost, for example, if you have a building and if the rent is 10,000, so if you use it, you still have to pay rent. If you don't use it, you still have to pay the rent. So the rent will go anyway. So under the marginal costing, we do not consider fixed cost, because fixed cost is like a sunk cost. It will happen anyway. All right, let's move to the next one. So we have a profit statement under the marginal costing, and we have a absorption costing. So let's try to do that. We have a sales, we have a cost of sales, the opening inventory, they didn't give it to us. For the marginal, then the variable production cost for the absorption, then closing inventory, cost of sales, contribution, and the fixed cost. The contribution will be only for the marginal, because for the absorption, we do the profit, not contribution. All right, let's look at the opening and closing inventory first. We can see the question said we have opening inventory 800. Question didn't say anything about the closing inventory, so we need to do some workings. So you can see we already have 800. So 800 is the opening, and we make another 2400, and we sold 23,550. So you already have 800 from the last period, that is opening, and we make another 2400, and we sold 2350. That means the rest of this thing is still on the stock, and this is our closing inventory. So you already have 800, we make another 2400, that's the production, and you sold 2350. So you have on the stock 850. 850 you have on the stock. That's my closing inventory. So this is the way we can do the calculation for the closing inventory. Now this closing inventory will be valued. If I use the absorption costing, then I'm going to use 13, the full cost that we have calculated before. And if I use the marginal costing, I use only the 9. Anyway, let's do this one. So we have opening inventory. This you already know, 800 times by 9 times by 9. So 9. Why 9? Because marginal cost is 9. 7,200. So inside of 9, there is no fixed cost, only the variable cost for the marginal. So 7,200 is for the opening. Then you have a production. Now you have to find the closing inventory. We know the closing inventory 850, and for the marginal is 9. So let's do that. 850 times 9, and it gives me 7,650. 7650, that's the closing inventory. 7650. And closing inventory always take away. Opening inventory plus production less closing. And that will give us cost of sales. So opening inventory plus the production less the closing. So let's do that. 7200 plus 21600 minus 7650. That will give us 21150 cost of sales. 21150. That's my cost of sales. And we have to minus the cost of sales from the sales. And that will give us the contribution. That is 23,500. And you have a fixed cost. If you minus the fixed cost from here, then it will give us the profit. So we'll get the profit 13,900. That's it for the marginal. For the absorption, we do the same thing. The cost of sales, we need to find the production cost. So how many we make? We make 2,400, isn't it? So 2,400 unit we make, and per unit is 13 pound. So 2,400 times 13, that will give us 31,200. So the production cost is 31,200. So you have opening inventory plus production and less the closing inventory. So you do that. Opening plus production less closing, and it will give you the cost of sales. So you can see the cost of sales will be 30,550. And after we minus it from the sales, and that will give us the profit. That is 14,100. That's it. It's not very difficult. If you practice a little bit, you'll understand it. All right, let's move to the next one. The next one we have complete the following sentence. Okay, let's do that. What is required? They said to method inventory valuation IS2. Normally IS2 always pay for absorption costing. Remember that. So absorption costing is required. Under IS2, always we have to value the inventory under the absorption costing. So absorption costing require method of inventory costing under IS2. IAS2 also require inventory to be measured at, remember that inventory always, or inventory should be valued at a lower of cost and the net realizable value. So between these two, you always have to pick the lower one. For example, if your cost is 10 pound, and if your NRV, net realizable value, is 8 pound, we have to pick the 8. So we have to pick the lower one between these two. This is the rules of IS2 for the inventory. So measures, so it said lower of cost and the NRV, net realizable value. What is net realizable value? NRV is basically the market value less cost to sales. Cost to sales. And this is the NRV. Okay, let's move to the next one. The next one here, task 4. This is like theory question, so I'll leave this one for your homework. This is the ethical question, so I think it's nothing to understand here. Just you need to read and you need to know how to write. Move to the next one, task 5. Let's try this one. This task from the management accounting costing again. So Jonas has asked you for your help in calculating the total cost for a new one-off job specially requested by a client. Remember that when a specific job requested by a client, overtime will be treated as a direct cost. So if any job, if you do a normal job, overtime will be treated as an indirect cost or indirect overhead. But if it is for one customer, for example, if one of your customer asks you to make a house for him, and if he give a design, like a separate design, so that will be anytime you spend, that will be direct cost. So for example, if you make a lot of same house for everyone, so any overtime will be indirect cost. So any order is specific for one customer, the overtime will be treated as a direct cost. Okay, let's have a look at this one. So this one is says, so Jonas has asked you for help, okay? He has provided you with the following information. So you have a direct material, direct labor, and direct labor hour, okay? The policy of Souter is to allocate fixed overhead as follow. Fixed production overhead, £4 per labor hour. So you have to know how much is the total labor hour, and you have to multiply by 4 because it says 4 per labor hour. Fixed administration overhead, 60% of the total production cost. That means you have to calculate the total production cost first, and you have to do 60% on that to find it out how much is the total production cost, fixed admin overhead from there. Souter apply 15% markup on cost on one-off job. So whatever is the cost, we have to add 15% as a markup. Remember, the markup and margin very common in the exam. So markup is basically on the cost and margin basically on the sales. So if we have a total cost, we just added 15% the markup. So let's do this one. First one, you have a direct material A, so £800 is already given. Then we have a direct material B for department B, 1400. Direct labor for A, they are saying the direct labor we have here, £12 per hour and 14 hours. So let's do that, 14 times 12. And how much it is, that will give you 168. So 168 we have for our direct labor. Then direct labor for B, the same thing. We have a 22 times 10. So 22 times 10, it will give us 220. So 220. After that, we have a fixed production overhead. Now the fixed production overhead, they said it is the total £4 per labor hour. So let's add how many labor hour we have. So we have 14 the labor hour plus 22. So this is the labor hour we have, and per labor hour we have £4. So multiply by 4. So 14 plus 22 times by 4, it will give you 144. So we have fixed production overhead to 144. Now we have to add all of this to find the total production cost. So let's add this one, and that will be 2732. This is my total production cost. After having the total production cost, we need to see how much is the admin. So let's do that. We'll do a little bit here. Okay. So we'll say here, the fixed overhead, fixed admin overhead, that's a 60%, they said. So 60% of the total production overhead. Okay. So we have calculated that 2732. So we do 2732 times by 60% of that. So how much it is? 1639. 1639. And if we added all of this with this one, 2732 plus 1639, and this one will give us the total cost. So total cost will be 4371. And if we minus it from the sales, that will give us the profit, but the question didn't give us the sales. They said find the selling price. So the selling price will be 15% of the cost. So whatever the cost, we added 15% of the profit. So 4371 times 15% of that, and it will add it with this one. That will give us a selling price. So let's add 15%. That is 656 So to find the selling price, all we have to do, we have to add this one, the profit with the cost, and that will give us the selling price, 5027. To find the total cost, all you have to do, we have to find how much was the total cost, the production cost, 2732 is all the cost added, 2732. With the 2732, we have to add the fixed admin overhead. Now the fixed admin overhead is 60% of the total production cost. So 60% of that. So if you do 60% of that, that will give you your figure, that is 1639. So if you added the 1639, so 2732 plus 1639, and that will give you 4371. All right, Umang? All right, so this is the activity 5. So let's move to the next one, activity 6. This one, it says you have been requested to complete the draft financial statement position for Sauter as at 31st of December 2017. Okay. Jonas has provided you with the following trial balance at 31st December 2017. Okay, we have a non-current asset cost, we have inventory, we have a sales ledger control, drawing, cash and bank, capital, non-current asset, accumulated depreciation, profit for the year, purchase ledger control, bank loan, VAT, allowance for the doubtful debt. And you have to complete the financial statement. Okay, so you cannot do it here, but what we can do, we can see here we have a trade payable and we have a VAT is already given, the current total liability is given, the bank loan is given. Okay, so you need to complete that, but we'll do in the side because you cannot do it two at the same time. Okay, let's do that. First, start with the non-current asset, task 6. So NCA, non-current asset. So we have the cost, and from the cost, we have to minus the accumulated depreciation. So let's do that. So you have a cost. And the cost of the non-current asset, let's find it out, 390,000. So write 390,000. And we minus the depreciation, accumulated depreciation, that is 167,000. And that will give you 223,000. Then you have a current asset. Current asset. So current asset, we have a cash at bank. Accumulated depreciation, we have this one, 167. Then we have a cash at bank. So cash on bank, that is 28,000. And we have inventory and 86,000. 86,000. What else we have? We have a sales ledger control, that is trade receivables. Now we need to see, is there any allowance for the doubtful debt, because you have to minus it. So you can see you have allowance for the doubtful debt, 1120. You have to minus this one. Remember that. Always you have to minus the allowance for the doubtful debt from the sales ledger control. So I said sales ledger control or trade receivables, 56,000 minus 1120. So 54,880. Okay, if we added all of these three, that will give us my total current asset, and that is 168,880. And you have to add it this one with that and minus with the current liability. So let's do the current liability. So total current asset is this one. Now look for the current liability. Current liability. Let's look for the current liability. So current liability, we don't see it anything here. We have a purchase ledger control, yeah, trade payables, 62,400. trade payable 62,400. We minus that, and then we have a no, we don't have any more current liability. We have a non-current liability, bank loan 13,500. So non-current liability, that is 13,500. And the VAT 6580. Yeah, we have a VAT as well. Yeah, VAT also liability, current liability 6580. We minus that, and that will give my net asset. So first we have to see how much is the non-current asset. With the non-current asset, we add the current asset. From the current asset, we minus the current liability, then the non-current liability. And so total asset minus total liability equal the net asset. So that will give us the net asset, and that will be 309,400. That's my net asset. Now we have to find another section, that is finance by section. So finance by section is very simple. Finance by, the finance by section is start with opening capital. So opening capital, any capital from the trial balance. We add the profit. Is there any profit during the year? So profit during the year. We minus if there's any drawings. So drawings, and that will give the closing capital. And the closing capital actually it has to be equal to the net asset. So closing capital has to be matched with the net asset. So let's start with that. Opening capital. On the question, you can see we have a capital introduced 200,000. So capital 200,000. After that, we have a profit. The question said profit for the year 151,400. So plus 151,400. And is there any drawings? Yes, we have a drawings. Drawings 42,000 minus. And that will give us the closing capital, and that should exactly match with our net asset. So net asset 391,880. And remember that if the question comes like that, you always have to check, is there any more information involved here? So let's have a look. You can see some information is already given. So trade payable and the VAT already given. If they give this one, don't be confused. You really don't have to do it again. If the question already give it to you, doesn't mean like you have to do it again. So sorry, this should be 309, isn't it? It's 309,400. It has to be exactly like your net asset. If anytime, if your finance by section doesn't match, if your finance by section doesn't match with the closing capital, or the finance by section doesn't match with your net asset, remember you have to double check because you definitely done some mistake. Otherwise, the net asset always has to be equal with the closing capital. So we have to do is a very simple format. Non-current asset, you add the current asset, and after that you minus the current liability, the non-current liability. So total asset minus total liability will give you the net asset. So you stop here, one side is done. You move to the next section. The next section is called finance by section. On the finance by section, you do opening capital from the trial balance plus the profit for the year minus the drawings, and that will give you the closing capital. That's it. So that's how you can do the financial statement for the limited company or for the sole trader. But if the financial statement or if the SOFP come from the partnership, remember it will be different. The first section will be same, non-current asset, current asset, non-current liability. But the other section, the finance by section, will be different. This time it will be partnership current account, and that time it will be partnership capital account. So if you added this two, that will be equal to the final bisection. So always remember the difference between the partnership financial statement and the limited company financial statement. So it's very important. All right, this is the end of our practice assessment 2. And if you practice a little bit more, you will see it's not very difficult. If you practice few questions from this question, you'll be absolutely fine. And more you practice, you'll feel more easy the question.